Meet Tom. Tom is a few years out of college with a great job and a lot of credit card debt. Tom has just watched our video, How to Get Out of Credit Card Debt, Part 1, so he understands that balance transfer credit cards are a good debt management solution. Unfortunately, he just can't qualify for one with a big enough credit line. What should he do? Well, Tom's not out of luck. He can instead use a personal loan to pay off his remaining credit card debt. Personal loans are great. They come with fairly low credit score requirements, generally around 640, and have interest rates lower than almost every credit card. Not only that, most modern personal loan lenders will allow you to check your rates for free without hurting your credit score. In the end, these loans actually only have one caveat. You just have to be sure that their one-time setup costs are less than the interest you'll save by transferring. If this seems confusing to you, don't worry. We do the math for you on our website. Plus, we teach you everything else you need to know in our video, Personal Loans 101. Finally, even if personal loans don't work, there are still a few more last resort options beyond asking your friends and family for money. Option 1. You could use the money in your retirement accounts, like a 401k or IRA. However, this option is problematic, as any withdrawal before age 59 and a half will be subject to a 10% penalty, plus taxes. Not to mention, raiding your retirement account is generally a bad long-term move. Option 2. You could use a 401k loan, in which you borrow up to 50% of your current 401k contributions, up to a maximum of $50,000. This definitely has advantages. There's no credit check, plus the interest rate will almost be certainly better than your credit card. However, there are serious flaws to this loan as well. Not only are you prohibited from contributing to your 401k while the loan is active, but if you leave your job, willingly or not, you'll only have 60 days to repay the loan. Otherwise, it's considered an early withdrawal. Finally, we have option 3. You could use a HELOC, which is a revolving line of credit, like a credit card, just much larger and secured by a house. Again, this has advantages, mainly a lower interest rate, but it's balanced by a major flaw. Unlike a credit card, failure to repay a HELOC could result in losing your home. Finally, if none of our proposed solutions have solved your problem, we highly recommend contacting the National Foundation for Credit Counseling, or NFCC. They're a nonprofit whose goal is to help you avoid bankruptcy. To this end, they'll create a personalized payment plan for you and work with your lenders both to reduce your debt load and your interest rate. Hopefully you and Tom now have a better idea of how to get out of credit card debt. If you want to see our balance transfer card recommendations, or just more educational material, be sure to check out our website.